Financing and settlement. This lesson is going to give you an insight into what you need to know as an agent about financing. We will never be the financing expert, but we will always be able to answer questions periodically about financing and settlement, meaning at closing, because there's a lot that goes into getting someone through the financing and closing. And sometimes those clients have more of a relationship with you than they do their lender. So it's very important for you to know just enough to be able to answer a few questions, give a tad bit of guidance back to the lender. So we'll talk about that today. First of all, is there's several different types of or methods of financing, we should say. One method is going to be the conventional thing that you know best is conventional loans, FHA, VA. These are loans with extensive regulations and guidelines. So these are loans that have a specific list of guidelines that most people have to check off each one on the list in order to be approved. And then we have unconventional financing, which sometimes these are loans that are not required to adhere to the FHA, VA mortgage guidelines that we see most normal conditions financing in the market area. For example, an unconventional financing might be seller financing. It's a deed to trust. It's a third-party document of financial status, if you will. This piece of seller financing sometimes has a little bit more of a big loop to kind of work around. We're going to go over a little bit later. Then you have a purchase money mortgage, which is just like a regular conventional mortgage. The unconventional part of it is the seller is the bank and not a regular bank. And then, of course, self-employed stated income. Now, we as agents, we're self-employed. It's more difficult to get a mortgage when you're self-employed than it is when you have regular income, pay taxes on a W-2, those kinds of things. So this is a little bit different of an unconventional financing because we have to jump through a lot of financial hoops as a self-employed person to get approved, much more so than someone who's getting FHA, VA, or conventional financing. Now, this is the part that gets most people when you're talking about title theory, lien theory of how title is taken and how a deed or mortgage is taken at the closing. So a lien theory state is the lien is held by the mortgagee, who is the lender, against the property. And the mortgagor, who is the buyer, retains ownership. That would be us, right? You would think that's Alabama. That's how we do it. Although, hold on. Title theory states is the mortgage docs are conveyed as ownership. So a title theory state is the mortgage documents are conveyed as their ownership. In Alabama, we are a title intermediary theory state, which means an intermediary theory states function where the borrower retains title. Okay, you as the borrower would retain title. However, the lender can take back the title if the borrower defaults. Similar to a lien theory, to where the mortgagor retains ownership. But the intermediary is where we can lose the property if we default on the loan. So those are the three different types. Now, mortgagor, mortgagee. Remember how we've been talking in class about the give-or is the OR person, the give-or, in this case, the give-er, G-I-V-E-R, is the give-or, the OR person, mortgagor, right? And the EE is best remembered as receiving, is that that's the person receiving the EE. Well, this is where it might be completely opposite in your mind. So just something to think about for the test. So in initiation of the mortgage, the buyer is the mortgagor. I know, completely opposite, because you're thinking the lender is the give-or of the mortgage. Kind of. But more importantly, the most important part is that the buyer is the give-or of the payment. The buyer is the give-or of the payment. The lender, who is the mortgagee, is receiving the payment. So the lender does move the loan amount over to the mortgagor, the buyer. But the buyer is giving give-or of the note and mortgage to the lender each month in a payment. When that loan is fulfilled, it's completely paid off. The buyer has been the give-or of the payments, right? The give-or of the payments. And the lender, at the fulfillment, at the end of the loan, the lender gives back, like the mortgagee, the lender, the mortgagee cancels the note of the mortgage having received all of the payments. So it's just opposite of what you might think, something to keep in mind. A mortgage and a trust deed requirements. It's a note of evidence, note or evidence of the debt. The mortgage and the trust deed are evidence of the collateral pledge. So the note or the evidence of the debt, and the mortgage or the trust deed is evidence of the collateral. The deed of trust does not transfer the ownership as a typical deed. Remember, when you get a deed, that is transferring the ownership. The deed proves your ownership, not necessarily in a deed of trust. Look at this diagram. The trustor, the borrower, the trustor, remember, was like the mortgagor, the borrower pays for the home and receives legal title once they satisfy the debt. In a deed of trust, the borrower, who is the trustor, the giver of the payment, they are giving the payment to the lender, right? The lender or the owner of the parcel. If it's a seller financing, it might be the owner of the seller financing does a deed of trust. The trustor is the giver of the payment because they're trusting with payment. The lender or the owner they hold the ownership and they hold the financing. That's the beneficiary. The trustee, the receiver person, the trustee is a third party who holds legal title for the benefit of the other. The trustee is they're receiving the legal title, right? They're receiving the legal title until the trustor pays off the beneficiary. The trustee is holding the title for the benefit of the beneficiary. Now, there's a few concept words and just terminology that you want to remember for mortgages. The principal. We've learned under contracts in the contract section that the word principal could be someone inside the contract. Your buyer's agreement, the buyer is the principal. In the contract, the buyer or the seller is the principal of the contract. When mortgages, the word principal could be the amount of money that's been borrowed. It's the lump sum of money. Your mortgage has a principal balance. So the principal is the amount of money you've borrowed. The principal balance is the amount of money that is owed at any given time, whether it be month 1 or month 300. So the principal balance is your loan balance of whatever you owe. Equity is the difference between the market value of the property and the loan balance that you have. So if you have market value up here and your loan balance right here, so now we have these two, all of this in between is the amount of equity you have. You have loan to value ratio. The ratio is created by comparing the loan amount to the value of the property. So you have the loan amount divided by the value of the property. That's the loan to value ratio, which is a percentage. A ratio is a percentage. This value is according to the lender, which will also be the lower of the two numbers, the sales price and the appraised value, meaning you cannot have the value of the property, the appraised value cannot be less than the sales price. Should it be less, then we use the lower of those two numbers, which would then go to the appraised value if it's the lower number. Interest or interest rates. Of course, no one's going to give you money for free. So this is the charge for the use of money that is borrowed. Points, also known as discount points, is an additional yield on a loan, or in other words, upfront interest to receive a lower rate. A buyer may have an interest rate of 6.5, but they could buy down their rate to 6.25 or 6%. Well, to buy down that rate to get it to a lower interest rate, they have to pay a discount point. The lender's not just reducing rates for free. You literally have to pay down that, buy that interest up front. So you're buying your interest up front instead of paying it over 30 years. The term is just that. It's the 30 years. It's the period of time of which the loan could be repaid. And of course, the payment is the loan term, the period of time, the loan amount, and the interest rate combined. So a payment is they divide the amount of money by 360 months or whatever it is, and then your interest rate combined based on that balance. You only pay interest on the balance at that date. You don't pay if you buy a house for 350. Your interest is not on 350 for the entire life of the loan. Every time you make a payment, the balance comes down a little bit more and a little bit more and a little bit more and a little bit more. You only pay the interest on what it is each month. Each month. It's called simple interest. Now, a promissory note is the borrower executes a note. The maker or the payer of the note. The borrower executes a note. The lender is known as the payee. The borrower is the payer. This can also be assigned. All who have an interest in the property should sign the note. So if you have an interest, you're an investor, if you're an investor, there's three of you, and you all three have to sign the promissory note saying, we will repay this to the payee, who is the lender. Now, inside your mortgage, there's several mortgage clauses that you're going to need to know these for the term and maybe the definition. So we'll go over a few of those. A reconveyance clause. In a deed of trust, a reconveyance clause requires that the trustee, remember, they're the third party. The trustee is the holder of the title. The reconveyance clause requires the trustee to reconvey the title. Well, to convey means what? To give, to hand over. I convey this to you. So the reconveyance clause is the deed of trust is conveying title to the trustor, who is who? The borrower. The borrower is the trustor when the loan is paid in full. So the third party in the deed of trust is sitting over here and they're holding this title. And once you as the borrower pay it off, the trustor, the third party, will hand that to you because you paid it off. They're holding it for the beneficiary. The beneficiary is the lender. So the deed of trust is it's the triangle. You're at the top as the trustee, as the trustor. You're the payor of the money. The trustee is a third party. Maybe it's an attorney, someone who's holding the legal documents until you pay. The beneficiary is the lender. Well, that makes sense, right? Because they're benefiting from the mortgage payment and the interest. So it makes they're the beneficiary. You receive this title is conveyed to you as the borrower once you pay the loan in full. Reconveyance, we're reconveying it to you. A release clause is when the mortgage is paid in full, the lender must release its interest. So in a regular lender mortgage document, and they record that mortgage as a lien against the house, the release clause is when the mortgage is paid in full, the lender must release their rights to the house. They have no more interest. The power of sale clause allows for the property to be sold at public auction in the event there's a default without having to go to court. So the power of sale gives the lender the right to go to the property, foreclose on it, and hold a public auction if you become in default. A defense clause, defiance, gives the borrower the right to defeat or remove a lien by paying the indebtedness in full. So you can defeat the lien against your property. And how do you defeat it? You pay it off. So it's a paid in full clause or a defiance. Just think of in your mind as a defeat of the mortgage. An alienation clause means due on sale. Allows the lender to collect full payment from the mortgagor, the borrower, remember, when the property is sold. It prevents loan assumptions without the lender's approval. So if you sell the house and you have an alienation clause in your mortgage, most people do. That means when you sell the house, the mortgage is due. You can't sell the house to Jane and then you move to go buy something else and you take all the money through. You sold the house for $350. After your expenses, you might have collected $335. You can't take that $335 and go pay cash for a house because you've got to give her a clean title. And guess what? You can't clean the title of the liens because you didn't pay off the mortgage. So you have to alienate, right? All things off the lien. So you're going to pay it off due on sale when it's sold. Alienation clause. Acceleration clause. In the case of default, it allows the lender to call the note due and payable if the borrower is in default. So let's say you have a house and you're trucking along and times get hard and you miss 1, 2, 3, 4 payments. And about payment 4, 5, or 6, you've been getting letters every month and getting phone calls and letters every month. And they're saying to you, you're about to go in default. You're behind on your mortgage. You're behind on your mortgage. You're behind on your mortgage. Well, about month 5 or 6, maybe before, you get an acceleration letter. And it's a little letter from the bank that says you are in default and your mortgage has been accelerated. The due date, the final due date of 30 years from now has been accelerated forward, moved forward to allow the lender to call your note due now. We're tired of dealing with you. We're tired of the behind payments. Go ahead and pay this off, $300,000 by December 1st, or we will proceed with foreclosure proceedings. That's what it is. Acceleration clause. An escalation clause allows the interest, that's the payment, to adjust over the life of the loan. So escalation means that the interest could escalate up. It could go up, down, probably more just up. Allows the interest inside the payment to adjust over the life of the loan. Well, if the interest adjusts over the life of the loan and the interest shoots up, what does your payment do? Shoots up. Exactly. A subordination clause. Under certain circumstances, a lender with a first lien position will agree to switch and take the second lien position. So it might switch and it will subordinate. Sub means what? To go under something. So it will subordinate to another lien, typically a first mortgage or a regular mortgage. And this example might be you have a construction loan and you're going to do a regular loan. So when the regular loan gets recorded, the construction loan will subordinate until all things are completed, and then it will go underneath. It will become paid off, and the regular mortgage becomes the first and primary lien holder. A prepayment clause. This sets forth the terms under where a note can be paid off early. It could or could not be paid off early. Rarely do you ever see where the bank says, don't pay us off early. We do not want your money in year 10. We only want the final payment on year 30. Well, you rarely ever see that, if ever. But a prepayment clause says you can pay this off early or you cannot pay it off early. And a default clause. This is going to require that you make timely payments. It's a if you pay, you stay. If you don't, you won't. It makes timely payments. You upkeep the property. You pay the property taxes, insurance, and you have permission from the lender to make improvements that are to be made. So it's called a default clause. Now, one thing about all these clauses is, hey, you can't get there. You can't even use all these clauses if you don't get the buyer qualified to get approved for the mortgage. To get the buyer qualified, the lender uses 2 scores to determine how much how much can be loaned to a borrower. So you have an automated underwriting credit score. It's a process in which a computer program developed by Fannie Mae reviews relevant information in the loan application. So you put everything in your own loan application, you put all this information in, the lender takes that application, puts it in their system, and there's a computer program that produces a 3-digit number, which indicates to the lender a borrower's capacity to repay. Now, let's just say you put that in and your credit score, right, is 670, 680, 710. Well, they don't use all 3 numbers. I mean, they do use them, but in this sense, they look at all 3 numbers and they take the middle number as the credit score. The middle number is what they use. And the computer program produces this middle number, the 3-digit number, and it indicates to the lender your capacity to repay the loan. So if your credit score is 670, 660, whatever it is, and it's on the low side, but you have another number that's 710, which says, hey, this credit bureau sees them doing very well. This credit bureau sees them as a little bit more of a risk. So we're going to meet in the middle. We're going to use the middle score. And then you have qualifying ratios. So they might have a decent credit score, but guess what? They've got to qualify on the ratios. Ugh, this is where people really have a hard time. They might have really good credit scores. Well, it's because they pay all these credit cards and car payments. The ratios that is used by a lender to decide whether a buyer's income compared to their debt allows them to qualify for a particular loan program. Ratios can change with market conditions, so you won't ever be asked about, oh, what is the ratio required for this? Because they change from year to year. But you have to know that there is a certain number that they have to qualify for. For example, I'll have buyers that say, well, I'm paying $2,000 a month in rent. I'm sure I can afford a $350,000 house, but they're driving a brand new car that they're spending $900 a month in car payments. And they have 3 credit cards that are pretty much maxed out. And they are paying all of that. But the reason their credit cards are maxed out is because what? They're living off the credit card. So that makes their debt really high compared to their income. And the lender says it's got to be under 43 or 41 or whatever percent it is, so that the lender sees that you have a little money left over for a rainy day each month. What if you couldn't work for 2 weeks? You'd have a little money left. So they look for those ratios to make a huge role, no matter the credit score and the buyer qualifications. Other qualifications that the lender may rely on, there's 8 types of information to determine what the borrower has, the borrower has the ability to pay. They look at their current income and assets. Well, current income might be not just from your job, but what if you receive alimony or child support? They look at your current employment status. Have you been on your job for a certain length of time? What is your credit history? That's where they come up with this credit number. The monthly payment of what your mortgage that you've asked to be approved for. So if you're asking to look to be approved for $250,000, then they're going to look and see what that payment might be. What does that fall? And then what is your payments on other loans? That $900 a month car payment plus 3 other credit cards. And then the monthly payment on the mortgage related expenses, the HOA, the insurance, and all those kinds of things. And then what other debt do you have? Do you yourself have to pay child support? That is a debt. People leave that off all the time. Child support, and if you pay alimony, that's a debt. So you have to count that. And a lot of people forget to count that because it might be automatically deducted out of their check. And then what monthly debt payments are compared to your monthly income, like we talked about earlier. So your income ratio is the monthly housing expense divided by your monthly gross income. I have a funny story. So my youngest son, he was trying to get approved for a mortgage. Well, bless his heart. He put on his application what his net income is, what his bring home pay is. And the lender calls me back and he goes, well, it's going to be hard, but he can get approved for like $85,000 to $100,000. And I'm like, what? No way. Put these kids through college. He can only buy $85,000. He'll never move out. He's the last one. Get him a house. Well, when I started investigating more, because I was so confused as to why he didn't make more money or better money, I was so confused. It's because he used his net income and not his gross income. So they go by your gross income, not your net income. So it's the monthly housing expense, meaning your house payment, divided by your gross income. That gives you your gross income ratio. Most conventional lenders require that this ratio be no greater than 25 to 28%. While FHA, they don't want it to exceed, right now, the number's 31%. VAs, they don't use a qualifying income ratio for this. The debt ratio, that's where you have your monthly housing expense plus your debt obligations. So if you wanted to buy a house for $250,000, let's say that payment's $2,350. So they'll take $2,350 plus your $900 a month car payment and your 3 credit card payments and child support if you have to pay it. They'll add all of that together and then divide that by your monthly gross income. That is your debt ratio. The debt ratio, FHA says it cannot exceed 43%, while VA says you can't exceed 41%. That goes back to that loan to value. The loan to value is the amount of the loan to the value of the purchase price. So if they say, oh, the purchase price is $250, and they say, well, you can't afford $250 because your debt ratio is too high. Well, then the lender might say, well, if you want $250, you're going to have to put down $25,000 so that you can get your payment down to meet the qualifying ratio. 80% LTV loan to value of $100,000 is $80,000. So how do people get all this money? Like, does the lender just have an endless supply of money? Like they're just constantly making loans, making loans, making loans? Of course not. The lender that you know of out in the marketplace, they're the primary mortgage market. They're making the loans directly to the borrower. They're the Wells Fargos, the Regions Bank, um, Rocket Mortgage, Mortgage Bank, Movement Mortgage, iDoLoans.com, whatever it is that is they're dealing directly with the public, okay? So they make the loan to the public. Well, then their funds get depleted, right? They just keep making loans, and it gets down here and it's almost gone. Well, then they stack up all those loans and they'll get all their mortgage documents and they package them all together, tie a little bow on it, and sell it to the secondary mortgage market. So they take all the loans and sell that to the secondary mortgage market, and that replenishes their stack of money that they can now lend. So it's kind of a life cycle of money in the mortgage industry. So the lender gives you the money as the borrower. They do 10 mortgages this month. They stack it up together, sell those 10 mortgages to the secondary mortgage market, and then they get another stack of the money to do it all over again. Now, who is that secondary mortgage market? Well, here are your three that you need to memorize. You have the Federal National Mortgage Association, who is known as Fannie Mae, FNMA. I would memorize these if I were you. You have the Federal Home Loan Mortgage Corporation, which is Freddie Mac, FHLMC, Federal Home Loan Mortgage Corporation. And then you have the Government National Mortgage Association, which is Ginnie Mae, GNMA. These are the people that hold your secondary mortgage market. Now, that primary market is going to look at two types of loans on the front end to the public, the lender, and they're doing loans like conventional, FHA, VA, and USDA. Those are the four types of loans they do. A type of loan. Then, inside those loans, some lenders might offer a program that could help the buyer qualify. NACA is a program. Home buyer assistance, first-time home buyers, and stated income. These are all types of programs that the lender might have when they are doing an FHA, conventional, or VA to help the borrower qualify. So let's take the first one, a conventional mortgage. Conventional mortgage. So this is a type of mortgage. A conventional mortgage can be used with investment or personal homes. A conventional mortgage can mostly be used for most any type of property. It has a loan limit of $766,550 in a conforming loan. Anything above that is called non-conforming. So the loan limit is $766,000. If they bought $1 million house and they put, this is a test question. If they bought $1 million house, they put $300,000 down, would they qualify to apply for a conventional mortgage? And the answer would be yes. If you said yes, you're correct. Because the 300 down, even though the purchase price is $1 million, the 300 down would become the loan limit of $700,000. Now, the down payment options with a conventional range for different minimums. You can put 3% down, 5% down programs, a 10 to 20% down programs. And you also have mortgage insurance. You have private mortgage insurance, PMI, with conventional financing. Now, here's the thing. Mortgage insurance on a conventional mortgage is only required if you put less than 20% down. So there is no mortgage insurance if you put 20% or more as your down payment. They do not require you to have mortgage insurance. But if you put less down on a conventional mortgage, they will require you to have mortgage insurance, which is called private mortgage insurance. And the acronym is PMI. It could change based on credit, rate of the lender. That's how they determine the down payment versus what it is that you have to pay in your private mortgage insurance. They come up with that number based on how much you put down and your credit score. Also, for a conventional mortgage, the closing cost for the buyer. So the buyer has closing cost, appraisal, title, closing attorney, buyer agent compensation, home inspection, all the things that the buyer, termite, septic, all these things add up, paying the lender, the underwriting fee, the processing fee, the origination fee. So all of these closing costs add up for the buyer. In most every loan, the buyer can ask the seller to contribute from their net to pay part of the buyer's closing cost. On a conventional mortgage, they have 3 different programs to do so. If you put 5% down, you can ask the seller to pay up to 3% of the purchase price in your closing costs. So for example, get a calculator. If you have a house for $250,000 and you put 3% down, which is $7,500. I'm sorry, you put 5% down, $250,000 house times 5%, you put $12,500 down. You can ask the seller for 3% in closing costs. So on $250,000 times 3% is $7,500. So here's what a question on a state exam might look like. Jane, the buyer, is doing a conventional mortgage. She is going to put 5% down on a $300,000 house. So that's $15,000, right? Jane can then, her closing cost is $12,000. But she is going to ask for the maximum from the seller in closing cost. Well, her purchase price is what you calculate that with. So it's 300,000 times 3%, which is $9,000. So her closing costs are 12,000. Her contribution from the seller is 9,000. So she has 3,000 left, correct? And her 5% down payment, which is how much? $15,000. So the test question might say, so Jane is going to purchase a $300,000 house. She's putting 5% down. She has $12,000 in closing cost. She's going to ask the seller to contribute the maximum, which is 3%, $9,000. How much cash will Jane have to bring to the table? So that would be, she has to bring $15,000 as her down payment. Her closing cost is 12. She's going to ask for 3%, which is $9,000. That leaves $3,000 left, plus her down payment of how much? $15,000. So you add the 15 plus the 3, and we're going to say that's answer B of $18,000. That could be a likely test question. Matter of fact, I think that's a pretty good test question. And it goes on. 10% down, you can ask the seller to contribute 6%. If you put 20% down or more, you can ask the seller to contribute 9%. It's a lot of money. The condition of the property is not very restrictive in a conventional mortgage, not as strict as it is with FHA, VA, or USDA, which has certain health and safety guidelines, but conventional doesn't really have a lot of those. Now, FHA, they have a loan limit, but not a purchase price limit. The loan limit is 524, 225 right now for 2025. Every January, I feel like it inches up. When I first got in the business 26 years ago, it was like $180,000. Well, now it's 524. That's over the average house price in Birmingham alone. So the loan limit versus the purchase price limit. So the loan limit is 524. There is no purchase price limit at all. They have a minimum down payment of FHA of 3.5% down. 3.5%, that's all you require. 3.5%. And it can even be a gift from a family member. The thing with FHA though is they require it to be an occupant. It's an owner occupant home, to where a conventional mortgage can be an investment property, not just owner occupant. But you can't buy an investment property with FHA because you're going to sign something at closing that says, I agree to live here. This will be my primary residence. You don't want to lie on a government insured loan. So it's owner occupant, not a non-occupant. Now, if you have a co-borrower, they can be a non-occupant, but the primary borrower, they have to be an owner occupant. The closing costs for the buyer that's being contributed by the seller can be up to 6%. So that's a lot of money. If it's a $250,000 house, that's over 12 grand. That should be perfect. They should not have more closing costs for that. So you can, on an FHA property, you can essentially get all of your closing costs paid by the seller up to 6%. Now with FHA is not that we say it's the type of loan because that's what we categorize it as, but they're not the lender. Federal Housing Administration, they are not the lender. The lender is idomortgages.com, Rocket Mortgage, Mortgage Bank, Regions, Wells Fargo. They're the lender. FHA, they are the insurer. It's a government insured loan. Mortgage insurance premium. So because you didn't put near 20% down, the government and the qualifications to qualify for an FHA are not near as strict as they are for conventional. The government says, we'll insure that loan for you, meaning we will take care of the lender should you, as the borrower, default. So the FHA has a mortgage insurance premium, and it's for the life of the loan. There is no, oh, I'm going to pay this down. On a conventional mortgage, the conventional mortgage, we should have mentioned this earlier, go back and write this down. A conventional mortgage, once you pay down to 22% equity, you can have your mortgage or private mortgage insurance, you can have it eliminated. So conventional, you don't have to pay mortgage insurance unless it is less than 20% down. And then once you get to 22% equity, you can take it off. But FHA only requires 3.5% down, and they require mortgage insurance premium, MIP, for the life of the loan. FHA, they're the insurer, not the lender. And they require so much more information and condition about the property. They say there shouldn't be any rotten wood, no holes in the carpet, no holes in the flooring, no broken windows, no peeling paint. Nothing that can have a health and safety regulation. So if it's over 20 inches, there has to be a handrail around the front porch. There has to be rails down the steps, because why? Somebody could fall and they're the insurer and they don't want to be sued. So they require a lot more health and safety guidelines than conventional. VA, they no longer have a loan limit. So if you're a veteran is the only one that can qualify for a VA loan. So the VA loan has no loan limit. It's 100% financing, 100%, no down payment required. Here's the thing. The VA, this is for our veterans. And while we as a country go, we say thank you for our service, for your service. Thank you so much for the service. But you can't use your VA to buy an investment property. It's only for your personal home. So no investment properties. Because again, it has to be your primary residence. The closing costs contributed by the seller, now they don't have to put in a down payment and they don't pay mortgage insurance because the VA loan is guaranteed by the government, not insured by the government. And the closing costs that the buyer can contribute, the seller can contribute for the buyer is 4% of the purchase price. So 4%, they can get up to 4% of closing costs from the seller. Now, the VA does have to pay a funding fee. They don't have to put any money down, but they have to pay a funding fee, which can be financed. So another test question could be, because they can finance this funding fee, it could say, Mark is an Army veteran, and he's going to buy a house for $200,000. Again, I need a calculator. So $200,000. Get your calculator, follow along. Remember, he doesn't need a down payment. So it's $200,000 is his purchase price. It's also his loan amount, right? Because it's 100% financing. But Mark has to pay a funding fee. And if it's the first time he's used his VA eligibility, the funding fee is 2.3%. So you take 200,000 times 2.3%, and that's $4,600. Okay, 200,000 times 2.3% is $4,600. So on your loan documents, you might see his loan amount is going to be $204,600. So the test question is going to read something like this. Mark, an Army veteran, is buying a home for $200,000. He's a first-time user, so he's going to finance his funding fee. They can finance it. So how much of his loan, what will be his loan amount at closing? So Mark, an Army veteran, is going to pay $200,000 for his house using his VA eligibility on a first-time use, 2.3%. How much will Mark's loan amount be at closing? Because he can finance the funding fee, 2.3% of 200,000 is $4,600. So you add the $4,600 to his purchase price, which is 200,000, which is also his loan amount, but he's going to finance his funding fee, making his loan amount at closing $204,600. There you go. And just like FHA, VA watches the health and safety. Same principle. No rotten wood, no holes in the carpet, no holes in the flooring, no broken window, no peeling paint, the handrails, all the things, anything that could pose a health and safety. The air conditioning must work, the heat must work. If there's appliances in the house, they must work, those things. Because health and safety, the appliances have to work because mainly the stove and the refrigerator, because you've got to be able to cook, fend for yourself, and you've got to be able to keep it safe and sanitary. Then there's seller financing. So this is an unconventional method of financing. Seller financing has two types: purchase money mortgage and or a land contract. So we're going to go over the first one, purchase money mortgage. Remember a couple of lessons ago, we talked about equitable title versus legal title. So legal title is just that. It is a deed that you hold in your hand, right? It's a deed. I have legal title is my deed. Well, equitable title is an interest, how much interest I have in the property. So under a purchase money mortgage, it works exactly like a regular mortgage from a bank. The difference is the seller is the bank and not idomortgages.com. So the seller is the bank. The seller gives the borrower, the buyer, the mortgagor, they give them the deed at closing. They sign the deed over at closing, right? They sign the deed over at closing. So the buyer has legal title and the seller has an equitable title. Okay? The buyer has legal title, the seller has an equitable title. And they establish a lien and they record it at the courthouse. Well, each month, the borrower, the buyer, mortgagor, if you will, pays the payment, pays payment 1, payment 2, payment 3. And when the final payment is made, then this lien that you may see, we'll use a different piece of paper. You see this lien, right? When the final payment is made, the lien is released, all gone, wiped away from your title, wiped away from being recorded on your mortgage, and you own the house. Now, with a land contract, it's directly the opposite. The seller, also known as a vendor of the land contract, they don't want to give up. There's a big risk here. They don't want to give up their title. They want to hold on to the title. They want to hold it a little closer and a little dear, right? I don't know. When you pay me off, I will give this to you. So that's a land contract. The buyer, because they don't have the title, the deed, they then have the equitable interest. So in a land contract, they pay the payment just like the purchase money mortgage is. Just like you're buying or renting, you pay the payment every month. Although when the last payment is made, then the seller comes back with the deed and says, here you go. You now own this in full, paid for. And they walk away. But you have to pay for it first before you receive the deed. Now, here's a term that drives me crazy. Hazard insurance. Really, it's known as homeowners insurance. The slang, we as patrons, right? We're the consumer. We want to shop for homeowners insurance. But on the test and even on the purchase agreements, the contracts, you will see it say hazard insurance. Now, when I say hazard insurance, I'm thinking there's a gas leak. That's a hazard. I need insurance against that. But no, hazard insurance means anything that can be done wrong or against you, right? That poses a hazard in your home or on your home. Hazard insurance is basically your homeowner's insurance. It's collected in escrow on most loans. Most loans have the hazard insurance collected inside your payment. You'll hear the term PITI, principal, interest, taxes, and insurance. PITI, principal, interest, taxes, and insurance. They place that in an escrow or trust account. So we've learned before that an escrow or trust account is where we're holding money for the benefit of others. Well, they collect this payment every month, every month, every month. And they hold it on your behalf as the borrower, and then they pay your homeowner's insurance, your hazard insurance once a year. Basically, because we say, oh, we're going to put that money in savings and we're going to pay it at the end of the year. And we're going to pay it every year. And we're going to put $35, $50, $75 a month, whatever it is, in our savings account and pay it every year. Well, what has happened? Life happens and you might not pay it. And the mortgage company, if you don't pay your homeowner's insurance, your hazard insurance, they will place their own insurance on your property and it's super expensive. So you don't want to do that. So for them to guarantee their benefit of being the house paid off, should a hazard happen, they pay it and include it in your payment. Now, flood insurance, that's an additional policy. Homeowners hazard insurance, it covers things like fire, flood, total loss, destruction. But hazard insurance doesn't cover flood like you might think. There's two different types of flooding, according to hazard insurance. Flooding from the outside in, that requires a flood policy, flood insurance, flood policy insurance. It's an additional policy. The floods are not covered on a typical homeowner's insurance policy. It covers structures as well as personal property damaged from the water that is intruded from the outside into the inside, right? Flood insurance cover on your typical hazard insurance might be floodwaters that came from the inside, like a busted water pipe that ruined your floors from the dishwasher or the tub or the water heater or the washing machine. But flood insurance, that's an additional policy that might be required by FEMA, is to protect you from waters from the outside coming in. Like if you lived in a flood plain or near the river or lake and the water might come in, then that's when you would need flood insurance. The mortgage insurance, we're going to touch on this one more time because we've already talked about it with both types of mortgages. So you have PMI, private mortgage insurance. That is for conventional mortgages until your equity reaches 22%. But if you put down how much? 20%, then you don't need 20% or more, you don't need private mortgage insurance. MIP, that's mortgage insurance premium for the life of the loan on an FHA loan, no matter how much you put down. You could even, on an FHA loan, the minimum down payment's 3.5%. You could put 5% down, but you're still going to only pay the mortgage insurance until you pay the loan off. It's for the life of the loan. Now, all of this to say, there's a lot of federal financing regulations and regulatory bodies inside the mortgage industry. Terms to remember for these federal regulators. RESPA, Real Estate Settlement Procedures Act. The CFPB, they're the Consumer Financial Protection Bureau. TILIA, Truth in Lending. And then the newest one is the Frank-Dodd Act of 2010. It granted a rule-making authority under RESPA, RESPA gave to the CFPB authority to supervise and enforce compliance with the RESPA guidelines. The Truth in Lending, have you ever bought a car or had a personal loan at the bank? Then you signed a Truth in Lending. A Truth in Lending comes with any kind of mortgage or payment plan that I've ever noticed. Truth in Lending, it requires the lender to disclose to the borrower the cost of the credit or the borrowing the money. So they have to say to you by law, Truth in Lending, they have to say to you as the borrower, as the consumer, hey, you're going to borrow this amount of money and this is how much it's going to cost you. We call it the heart attack figure, the Truth in Lending. I'm paying $300,000 for the house, but by the time I pay 6% interest for 30 years, guess what? You look at that Truth in Lending number, that's why we call it the heart attack number. You've paid $522, $522,000 for this house. That's a huge figure, but you get the drift, right? You're never going to just pay $300,000 for the house. By the time you pay interest, you're going to have paid this amount of money. And that's why we say at closing, don't look at that figure, just keep signing, because it gives people a heart attack of, oh my gosh, this is I'm not buying the house for $300,000. I'm buying the house for, I'm going to end up paying $500,000. Well, you got to pay the lender the interest because they deserve to make money off the money they let you borrow. That's why they give you the Truth in Lending, so that you know what the entire package is costing you. It's called disclosing the APR. It's the interest rate plus the fees to the borrower, like the origination fee, underwriter fee, processing fee, interest amount, all of that toward the end of the loan. The Truth in Lending and RESPA in 2015, they combined the TILIA-RESPA integrated disclosures. It's called TRID. So in 2015, we replaced the old good faith estimate, that's what we used to call it, and the HUD 1. So what happened before 2015 was the lenders would give us a good faith, that would give us agents and the borrower a good faith estimate, okay? And then at closing, you would get a HUD 1 from the closing attorney. And every attorney put the numbers in a different place on a different line. And us as agents trying to review it, we're just like always trying to figure out where's this, where's that, where's this. And it was all over the place. So in 2015, TILIA-RESPA integrated disclosures, TRID, said that's enough. Everybody gets the same form. So they created the uniform settlement statement. Well, what also was happening before now when the market crashed in 2008, 2009, well, there's a lot of stories that go around about that. But basically, there were lenders that would change all the cost of the lending midstream of getting the mortgage approved because somebody might require a little bit more work to get approved than others. So you might have a borrower who said, I'm going to buy a house for $150,000. And the lender sent you the good faith estimate and said the closing cost was going to be $5,000. Okay, perfect. So I asked the seller to pay $5,000. Well, then we get to closing and the buyer is in tears because now the closing cost is $7,500 instead of $5,000. And they don't have an extra $2,500. Well, the borrower is freaking out because they don't have enough money. And the seller's freaking out because they've packed up. They think they're moving. They're closing on their house today. And the lender might be like, oh, it'll be okay. We'll just all pitch in at the closing table. If the borrower can find $1,000 for mom and dad, and the seller kicks in 750, and Michelle, if you kick in 750, then we'll be just fine. We'll come up with the $2,500. And here's me. Okay, Mr. Lender, what are you kicking in? Because I'm having to give up money on my commission. The sellers is giving up money. The buyer's having to go find more money because you changed the name of the game in the middle of the game. Well, that was happening all over the place. And I remember one time I said to a lender, if I was regulated like you, I could do whatever I wanted. If you were regulated by me, they'd shut you down. If I acted like you acted, I would lose my license. So they created the Uniform Settlement Statement, where now, since 2015, the borrower gets a loan estimate form at the beginning of the process. So at the beginning of the process, they're given a loan estimate form. And just before closing, they're given a closing disclosure form. And there's very little leadway for any changes now based by government. Hallelujah. So the lender must also give the applicant a SFPB, your home loan toolkit little booklet within 3 days. So once they start the process, they should be emailed this PDF of a booklet in the first 3 days. Well, the loan estimate form, they should also get that in the first 3 business days after their application, the loan estimate form. And it's going to have all the numbers disclosed to the borrower. This gives them all the numbers, their interest rate, their payment, all the things that they're going to have to pay within the first 3 business days of the application. And the borrower has to acknowledge it, meaning they have to sign it. And it's going to have disclosed the lender fees, the lender servicer fees, and the purchaser chosen servicer fees. So that gives them a whole detailed list of all these numbers. Then 3 days prior to closing, 3 business days before closing, they get the closing disclosure form. Well, that's going to have all the finalized cost and whatever allowed changes there are from that first loan estimate form they got in the first 3 days. Well, the lender fees, where the lender could make adjustments on their own fees. Like say, for example, the processing fee, the underwriting fee, and the um, interest rate and the origination fee. Well, the borrower now, I'm sorry, the lender now can make there's no tolerance. They cannot change any of those fees. The lender servicer fees, meaning the appraiser, the title company, the closing attorney, there's a 10% change tolerance not acceptable there. And then the purchaser chosen servicer fees, any change is tolerated. Well, if there is any change in the first two, the lender servicer fees, if there's any change in that, they have to redisclose and start over the whole form. And wait 7 days. If the lender servicer fees change more than 10%, if they don't redisclose on those first two items, lender fees and lender servicer fees, the lender has to eat whatever the overage is. Well, they don't want to do that because they don't want to pay it out of their paycheck no more than we want to pay it out of our paycheck. So the lender fees and the lender servicer fees can have very little change and fluctuation from the loan disclosure form, the loan estimate form, to the closing disclosure form. Now, the purchaser chosen servicer fees, any change is tolerated. And that's where there might be on your hazard insurance. So the lender may give you an estimate to say, we're going to give you an allowance of $100 a month for your homeowner's insurance. And you as a borrower go shop the homeowner's insurance. Well, the difference is you use State Farm and they're the most expensive one in Alabama. Well, guess what? It came in at $150 a month. Well, that's not the lender's fault that you chose State Farm instead of home mortgages or homeinsurance.com, who was only $75 a month. You chose the one that was double. That's not anybody's fault but the borrower. So no one has to eat that. That's on them. It's just going to make their payment change and hope they can still qualify. NARESPA, they prohibit the payment of fees as part of a real estate transaction when no services were actually rendered. So I cannot give a referral fee from an agent to a provider, meaning if the lender has a borrower, has a buyer, and they send me that as a referral, like they might say, let's say Scott says, hey, Michelle, I'm so glad we get to do business together for so long, but hey, I have a borrower and they don't have an agent and I have them approved. Why don't you take them and go sell them a house? Well, hey, that's a great commission that I didn't have, right? I can't give Scott a referral for that buyer. That's illegal. And there's no kickbacks to from the providers to the agent. So I can't send Scott all my business and say, hey, here's another buyer, here's another buyer, here's another buyer. Now, what you gonna do to help me? Okay, no kickbacks back to the agents. And that ends our financing settlement class. I hope you enjoyed. It's one of my favorite classes to teach. See you soon.